Hey there guys, how's it going? Chillingworth here. Welcome to episode number 3 of the series where we take a look at UK stocks and we're looking at the financial analysis essentially of a company to determine whether or not they are a company we want to invest in. Now, primarily our main focus is we're looking for companies that show the parameters required for it to be a potential growth stock. So we're looking for companies where we can maybe get in at £3-4 a share and see that rise to £30-40 a share over the next 5 years, let's say. Obviously it's all over the place, and those numbers can be up and down, but we're not necessarily interested in dividend stocks as such. Whilst we do get dividends from the companies that I own, they're not the primary focus. The focus is we're looking for share price growth. And there are a certain set of parameters that I've discovered that lead to that. On top of that, as another layer, what I've also done is I've created a score process. So once I've gone through the analysis, I have a scoring system for every stock, and we attribute that score to that company, and they appear on the wonderful leaderboard of truth. And here is going to be, as we go through the season, through the series, a list of companies that we have analysed and their reflective score based on the analysis that's been done. All 100% factual. There's no opinion, there's no emotion, there's no nostalgia, there's no like, oh, I love this company, they make great products, so I'm going to give them a bit extra. None of that. Purely based on the financials, which are 100% factual. So a company either does or doesn't make the grade. Essentially what we're looking for companies to at least pass 100 points on this before we're looking to potentially be investors. So far we've got nowhere near that. We looked at Tate & Lyle, they scored 10 points. We looked at AA PLC, the breakdown company in the UK here, minus 46, so not looking good. So last week in the Tate & Lyle episode, I did ask members, viewers, if they had any requests to put them down in the comments underneath the video, and if I can get the time, I'll take a look at those and we'll use them for future episodes as potential companies to look at. And thank you to everyone who did that. Thank you to the guys that left some messages under there. I presume as we go further, you might get more and more people doing it, but I've got plenty to work through now already. And I think it was James Agar who posted on last week's episode and suggested Royal Mail amongst many others that he suggested, and I'm going to try and get through all of them. So everyone, all the recommendations or the requests that were posted, I'm going to try and get through everyone's there. But I thought Royal Mail was a great pick because an interesting pick as well, because they're a household name, a British staple stock. I've met many investors who will just simply, when they don't know any better, they will just invest in these companies that they've heard of, like the BPs, the Vodafones, the Tate & Lyles, the AAs, companies that they assume are good businesses that have been around since the 80s or maybe even longer, who are probably a good company to invest in. And that's generally a very bad investment approach, and people get stung that way. And I think Royal Mail are another one of those companies that people will just naturally swerve towards when it comes to, where do I invest my money? Let's have a look at the companies on offer. Oh, Royal Mail, I've heard of them. They've been delivering my mail since the 80s. They must be doing pretty well. Maybe I should invest in them. So I thought that was a great opportunity to go through the numbers of Royal Mail, to show you guys what I'm looking at, to go through it together, to identify what's good, what's bad about Royal Mail, and then to ultimately give them a score and get them up on the leaderboard to see where they fare and where they sit amongst the others that we're going to look at throughout the series. The series. So without any more delay, let's dive into the numbers. Okay, so we've only got a few years worth of data. Now, Royal Mail floated on the stock market in 2013, so we've only got about 6-7 years worth of data on Royal Mail post-float. But we do have a couple of years pre-float data as well, so we can formulate a nice the more data the better, but we've got plenty here to get our teeth into to really understand what's going on at Royal Mail, so no issues there at all. first of all, we're going to look at the revenue. Now, many investors make the bad mistake, I think, of reading too much into the revenue. They believe that if it's got a good, strong, growing revenue, then that's all it needs to be a good investment. And in my experience, that's absolutely nowhere near good enough to warrant it being a good investment. For example, I've seen many companies. I've analysed over hundreds of companies now in the UK, and I've seen many companies that have a growing revenue and look really strong on their revenue, but their expenses are bigger than their revenue, or they're making losses, at the end of the year. And so the revenue, all it is kind of a starting block. It just tells us, is there business there? And is that business growing? Is the business growing bigger, and is it able to find more business out there? And that's quite important for growth stocks. When we're looking for growth stocks, we need that. That's an aspect that we need. If the revenue is flat, that would be bad. Or troublesome, i.e. if the revenue hasn't been going up for the last 10 years and it's been sitting at the same level, that's not generally a good sign. And then if the revenue is going down, of course, that's bad news. So revenue going up is a good sign, but on its own, not enough, right? So with Royal Mail, revenue has absolutely been going up. You can see here 2011 they were making 8.4 billion. That's now at 10.5 billion in 2019, and there's been a steady growth there as well, right? So there have been years where it's been a bit up and down, but there's obviously a trend here that the revenue has been going up. So that's a good sign. It means Royal Mail have been able to get out there and find more business and bring more business in and make more revenue over the 9 years that we've got there of data. So that's a good sign to start us off with. What I am concerned about the most here is the expenses. Now, as we can see here of the expenses, pretty flat for 2011 to 2017. Typically around 85 to 86% of the revenue is being eaten by expenses. So first of all, that's too high. The expenses are very high, and it means that it's costing them a lot to run the business. A lot of the revenue that's coming in is being eaten up. It's not high to the point where you're like, there's no way I would touch them, but it is high, and it's already a red flag and a concern. What's more of a concern for me, though, is, and I'm always looking for patterns, always looking for trends, because I think trends and patterns tell us so much about what's going on behind a business. Take a look at this. So the last 6 years, that the expenses have been sat at 81%, then 81.1%, so not much difference. Then it went up to 85.5, 86.1, 88.8, and now 98.5. So over the last 6 years, every single year, expenses have been growing. But not just growing, because with the revenue going up and the revenue growing itself, we would expect expenses to be going up, right? But what those percentages are telling us is that the expenses are growing at a faster rate than the revenue. Expenses are going up faster than the revenue's going up, because it's taken a larger slice of the pie. It was 81% of the revenue was being eaten up by expenses back in 2014. By 2018, that was 88, nearly 90% being taken up. Now, in 2019, that's gone up to 98.5%. So 98.5% of the revenue is being used by just running the business. So when we're talking about expenses, we're talking about marketing, advertising, staff costs, rents, utilities, insurance costs, all the stuff that it costs to run a business, essentially. Run a massive company like Royal Mail Group, a $10 billion £10 billion UK, £10 billion business like Royal Mail. It's like they've brought in a revenue of 10.5 billion, and it's cost them 10.4 billion to just run the business. So they're really not left with much at all, and those expenses are too high. So in 2019, that 98.5% is a big no-no for me. That's far too high. We can look at depreciation costs. They're fine. There's no real concerns there with the depreciation costs. It's not like they're out of whack or they're, far too big or anything like that at all. And we can say the same about the interest on debt. All well within the limits of what I would be looking for, and I'm comfortable with that. They're not paying massive amounts of interest on debt that's going to cause them major trouble. Obviously, the less they pay, the better, but it's not at a level. It has been going up, though, last few years, but then That's more on a percentage basis of the fact that the operating profits have been dropping. So, for example, we can look at this now with the operating profits from 2015 onwards. This is just the money that's left off the back of all the expenses and the depreciation being taken off. Let me get that back. So 740 million in 2015. That went down to 485, 490, then down to 236, and now down to 160. That's operating profit, 160 million. So again, a downward trend that we do not want to be seeing, right? And so you look at the actual interest on debt, it's pretty much been staying pretty standard the same, but the percentages have been going up because the operating profit that it's been taken from is going down. I've gone through the process of taking out all the extraneous circumstances, the extraneous income and the costs. So essentially what can happen in most of these companies that I look at, bear in mind I look at hundreds all the time of these companies, a company like Royal Mail could sell off an arm of their business, or it could sell an asset, it could be a building or a property or something like that, or maybe an intangible asset like rights to something, and it could make 100 million, let's say, selling this thing. For accounting purposes, that has to go into their accounts. And so a savvy investor needs to be able to work out, where is this income coming from? Is it coming from the recurring everyday business that it runs, or is it coming from extraneous circumstances, sales of so-and-so or sales of this? The reason why that's important to deduce is because if you include that in the results, these extraneous circumstances, they're not going to be able to rely upon selling that asset or that product or that thing every year, right? So if they sold an arm of their business, that's gone. They're not going to be able to sell it next year. If they sell the rights to something that year, it's gone. They're not going to be able to sell it next year. And so it's not part of their everyday recurring business. It's a one-off income. As an investor, what I'm looking for is I want to know, what's the recurring everyday business achieving? If they sell little bits of their business here and there, it's important to know that they're doing that. But more importantly, I want to take it out of the results so I can see what's actually going on underneath the bonnet, underneath the hood, right? So I do that. I take all that information out. That's all been done already. And obviously we go through the tax as well, but the tax, not much a company can do about the tax. And then we're down to the net earnings. What's the net earnings that the business has been making? I do the net earnings based on a percentage of the revenue. So what percentage of the revenue is being kept after all expenses have been extracted, after all costs? We're talking about the business expenses, we're talking about depreciation costs, we're talking about R&D, research and development, if it's applicable to that company. Not all companies do R&D. Royal Mail don't have any listing for R&D on their accounts, so presumably they don't really do much, but it's more prevalent in pharma and tech companies. Then we've got interest on debt and all of these costs that we're going through. What's left at the end of that as profit for the shareholders? And what we're wanting to see here, at least, is a growing net earnings, or a strong, solid, consistent net earnings, right? First of all, Royal Mail's net earnings amount is not high enough. They're not making enough profit out of this business for me to want to invest, first of all, and this is going to score them badly on the score. Secondly, there is a obvious trend, and the trend is that it's going down, right? So 2013, these guys had a 8.7% net earnings, 8.7% profit of the revenue that came in. They kept 8.7%, but then they went down to 5.9 in 2014. Went up a little bit to 6.2, then down 4.6, 4.2, 2.6, and then last year down to 0.8%. Now, a one-off year at 0.8% is like, okay, maybe something funny's going on here. Last year was okay. The year before that was okay. Just this year it seems to be dodgy. Maybe it's not quite so bad. Let's look into why that's happened. This is a steady, consistent trend over 7 years. That's bad, right? I mean, it's good that we can see this, but for Royal Mail, that's bad. For investors in Royal Mail, people who own shares in Royal Mail, that's not good. A consistent decline like that means something's going on. And we can generally see, I mean, it's the expenses that's costing them a lot. The cost of running the business is just so high that they're not there's nothing left for the shareholders, and that's a real concern for me. It's something that I would never go anywhere near. I'm not interested in any company showing a decline like that in net earnings. I want to see the opposite. I want to see companies going up in net earnings value if possible. But that's not always the case. I mean, sometimes if a company's making 25% profit every year and they're just consistently smashing that, that's great, But a company that's gone from 8.7 to 0.8% in the last 7 years, and every single year has been another step towards that decline, that's a concern. No real concerns around the assets against liabilities. They're not smashing it in terms of they haven't got a great amount of assets stored up and against their liabilities, but it's not bad either. What I wanted to look at here was the overall debt of the business. Always interested to know how much debt these companies are carrying. When they pre-float, so back in 2011, Royal Mail had a outstanding debt of 1.4 billion. And it looks like as they floated on the stock market, they've started to really take control of that, which is great. And so that's gone down to 973 million to 600 to 366. So by 2014, they'd got that outstanding debt down to 366 million. And that's great because at that time, the business was making net profit about 550 million. So what that tells me is that the level of debt that they have is fine based on the size of their business, right? So that's how you should always measure it, because obviously different companies, different sizes mean that different levels of debt are going to either be too big for them or well within their limits. And so I like to contrast the two and work out, okay, well, how long would it take the company, based on their net earnings, to pay off that debt if they needed to? That gives me, I mean, there's not what's going to happen. The company are never just going to pay off all that debt in one go, or very rarely do they, because there's always a cyclical process of borrowing, spending some or paying some of it off, but borrowing some more, paying some off, borrowing more. And so it's kind of like a conveyor belt of debt and lending going on. So rarely do they all pay it all off and then have no debts whatsoever. But it gives me a measure of what's the level of their debt against the size of their business. And at the time, back in 2014, it would have taken them half a year to pay off that debt based on their net earnings in that year. So that's well within their capabilities, right? Well within that's a level that we'd be very comfortable with. Now, the problem we've got with Royal Mail is that in the last year, 2019, they only made an £81 million profit, but they still got the same level of debt. They're at 431 million in debt. And at that point, now that they're only making 81 million, now that debt level is too high for that business, because it's now going to take them probably about 5.5 years at their current net earnings rate to pay off that debt. And that for me is a concern. That for me is too much. And so they need to reduce that debt, but how are they going to reduce that debt significantly enough when they're only making 81 million a year, right? Bear in mind that not all of that money can go on paying off their debt if they want to carry on growing the business, paying dividends, buying more assets to grow the company, all that kind of stuff, buying property, plant and equipment, stuff like that. So it can't all go on the debt. And that's a concern. That is a concern, that it's not the fact that the debt has gone up as such, although it has a little bit, but not by much at all. It's the fact that their ability to pay it off has dropped off. And that's a concern, unfortunately. The other thing I want to look at, and here's the flip side to all that, this is the kind of the best thing out of Royal Mail's numbers that I can really give you, is the reserves, the company's reserves. This is cash reserves. So when a company makes profit, they've got several things they can do with it. They can buy assets with it. They can pay dividends, which they often do, and then a certain amount of that money can be pumped into their reserves, and those reserves can be saved up to do whatever they want with, essentially. But it can be used for acquisitions and mergers and stuff like that. It can be used for paying special dividends. It can be used for a rainy day, whatever. It can be used for buying more assets when the time is right and an opportunity comes up, or buying out a competitor or something like that. Pre-float back in 2011, they had a reserve amount of minus 7.9 billion. So Royal Mail had some big issues before they floated. By the time they got onto the stock market in 2013, they had a reserve of 1.3 billion. So they're literally sitting on top of that money. That is money that they have squirreled away to do with whatever they want to do with, and that's what the board are there to do on behalf of the shareholders, to decide how do we spend that money, what's the long-term plan for Royal Mail. And this has been really solid by them, to be fair. They have dipped into it in 2018, but it's been growing pretty well. Now at a point where it's at 4.5 billion. So that's pretty damn good. This is a company that, despite the debt of 431 million, despite the fact that their earnings have dropped to 81 million a year, they are sitting on a cash sum of 4.5 billion. Now, there's two sides to look at that. There's the safety aspect of, okay, well, we're secure then. The business are secure. They do have 4.5 billion that they're sitting on. But it doesn't detract from the fact that the recurring everyday business, clearly there is an issue here, some sort of a problem. You could keep throwing money from reserves to make the numbers look better if they wanted to do that every year going forward. But it wouldn't solve the problem. The problem being, why are we now only making 0.8% net earnings? And throwing money at that's not going to fix it. There's obviously an underlying issue within the business, i.e. the expenses are far too high and need to be reduced. What can they do with that? Not so sure. But the reserves are the big positive of Royal Mail, I suppose. And then the other thing I wanted to look at was the return on shareholder equity, which is just atrocious. So essentially what that is what return is the business getting off the assets it's investing in. So when we're talking about assets, we could be talking about anything. Intangible assets, rights, trademarks, patents. We could be talking about property. We could be talking about plant and equipment that they've been buying, that sort of stuff. We could be looking at people that they've been bringing into the business, experts, whatever. An asset is something that they can invest in and buy that produces an income for them, adds to their revenue that's coming in. What's the return that the company have been getting for the shareholders on the assets that they've been purchasing? And as you can see, massive decline here, massive decline. And these are bad numbers. 2019's numbers are very poor. And we would expect that based on the fact that the net earnings has been dropping. So this company have been buying and buying more and more assets to add to their asset portfolio, if you will. And they've not been getting any greater return from it. And if you can imagine that, imagine being an investor and buying a load of stocks and adding them to a portfolio, and imagine these stocks represent your assets that you're buying, right? And none of those stocks are adding any value to your business. In fact, you're making less and less money. Those assets are not doing their job. If you're buying these assets or you're buying these shares for your portfolio, which essentially are the same, and they're not producing you any extra income. In fact, you're making less income, then those assets have not been a good investment, right? And it's the same for this business. They're buying these assets, they're investing this money into plenty of different things, property, plant and equipment, intangible assets, that sort of thing, inventory, that sort of stuff. If it's not producing an income for them, then it's not money well spent. From a shareholder point of view, and these are really bad numbers. This is a definite downward trend here, so that's no good. And then finally, the last thing I want to look at here on the numbers is the capex, the capital expenditure. So how much are they spending on intangible assets? How much are they spending on property, plant and equipment? The answer to that question is too much. They're spending a lot of money on this stuff, and it's above what I would want to see. So there are quite a few red flags here with Royal Mail, very few positives, I would say, and not a company that would excite me in any way, and certainly not a company I would want to invest in. Knowing all this, we can go and have a look at the chart very quickly. Okay, so this is Royal Mail Group PLC's charts. Let me just get rid of these little boxes. So we've seen a little bit of a spike today, because today we saw the result of the general election in the UK. The Conservatives and Boris Johnson won the victory there, and the stock market overall has seen a massive boost off the back of that. and Royal Mail, amongst most of the majority of UK stocks and FTSE stocks, have benefited from that, and that's why we've seen this little bit of a spike today. Mainly the home construction companies have seen a real big boost on that. But nothing can happen essentially in a day like a general election that would really make a big difference to the long-term picture of what's been going on at Royal Mail. That tiny spike that we've seen today that everyone's raving about right now is literally a drop in the ocean compared to what's been going on over the last 6-7 years. Now, as you can see with Royal Mail, when they floated back in 2013, they came in at a price of about £4.50 a share. Today, that share price is at £2.37 a share. So if you were an investor in Royal Mail back in 2014 and you've been waiting now for 7 years and your shares have dropped from £4.50 to £2.37, you're not going to be a happy investor. This is not a growth stock. And this is indicative of the numbers. So when we look at the numbers of a company and we look at the financials and we see the stuff that we've seen with Royal Mail, this is exactly the kind of chart I would expect to see, either flat or going down. Because investors are not going to be wanting to buy shares in a company with results like that. Where we see companies that are hitting all the parameters and the criteria that I look for, when they're meeting those criterias and they're scoring above 100 points on this, I guarantee you we will see a completely different chart for those companies, and you will see a company where the share price is soaring and doing fantastically well. And they're the kind of companies that we're looking for, companies that are meeting all that criteria and the share prices are going up. We're not getting into companies because their share price is going up. We're getting into the companies based on the financials. The share price going up is just the aside, it's just what's going to be the ultimate conclusion to getting involved in that company if they continue to operate in the way they're operating. Royal Mail have not done a very good job financially. Everything's pointing in the wrong direction, and as a result of that, this is exactly what I'd expect to see: either a flat market where the price goes nowhere, or a decline in share price, which is the exact polar opposite of what we're actually looking for. So, with that, having looked at the numbers, having looked at the chart, let's have a look at the leaderboard. Okay, so last week we looked at these two companies, or the last couple of episodes, we looked at AA PLC and Tate & Lyle PLC, and AA scored us a atrocious minus 46, Tate & Lyle scored us a plus 10. We're looking for companies that's going to score us over 100 points before we're going to be seriously considering them as a potential growth stock we want to invest. I'm only looking for the best of the best companies. When you have thousands of companies to invest in, I don't want to invest in a company where there is a better company out there for me to invest my money into, right? So sometimes we'll look at these companies, they'll appear on this leaderboard somewhere and they won't have a bad score, right? There might be, let's say they achieve 85 points, right? A perfectly good company, a company whose share price may well go up in the future. But when compared against other companies that are performing better and producing better results and are meeting my criteria better and more accurately, then I'm going to want to invest my money in that company, the company that got the better results than the 85-point company, right? So just to kind of give you an insight into my mindset and what I'm doing here. But we've got RMG, Royal Mail Group, is the epic code or the ticker code, whatever you want to call it. And we've just got to put their score on here and add them to the board. And I can announce, having gone through the numbers, having looked at the financials and plotted the results against my score analysis and my algorithm, if you will. I don't know what you would call it, really. I've put the score together. And this is the same score process for every company, by the way. So there's no opinion, there's no nostalgia, there's no emotion gone into this. Basically, the score is a factual, hard and fast mechanical approach that every company gets scored against. So it's equal. Every company has gone through the same process to get their score, if that makes sense. I can announce that Royal Mail Group, for episode number 3, have scored a rather disastrous minus 14 points. which puts them second on our leaderboard. Of a rather sorry looking leaderboard right now. Just get this out of the way. So, 3 companies down. All 3 of these companies, I'm going to expect by the end of this series, whenever it ends, if it ends, these guys will all be right down the bottom, because these are pretty poor numbers. We've made some bad choices to start with. And I don't mean that in so much that, these have actually been very interesting companies to look at, because Tate & Lyle, AA plc and Royal Mail are these household names. They are the British staple stocks that people will invest in purely based on the name and what they do, and the love for the product and stuff like that, and the service. But what we've seen here is that these are not companies we would want to invest in from an investment point of view if you're looking for share price growth. Dividend investing might be a different story. I don't really do much work on dividends. If you're a dividend investor, you might not care so much about growth stocks. You might just be looking at who pays the most in dividends, sort of thing, who's got the greatest dividend yield. But for share price growth that I'm looking for, these are 3 of the worst companies you could invest in my opinion, based on what I'm looking for, based on the facts, based on the numbers that we've looked at here. They do perform better. RMG has performed better than AA PLC, but if you're scoring minus on this, stay well clear is my advice. We are going to find companies throughout the series that are scoring over 100 points, and that's a world of difference from what we've been looking at, and you'll see that in the numbers when we look at these companies. You'll see that in the charts, you'll see the difference, and they'll be exciting companies because they'll be doing everything right, they'll be smashing all the numbers, and it'll be exciting to go through it, and you'll be exciting to see just the amount of profit these companies are making and growing. You'll see the share price and what it's been doing as well. And there'll also be companies where they've been doing very well financially and hitting all the buttons, but no one's really heard of them before. And when we go through those companies, again, that's going to be exciting because maybe the share price hasn't taken off yet. And we can get in on that, and that's an opportunity for people to get in now before they do take off, because they're already doing everything right financially. It's just investors haven't fully cottoned on yet. But yeah, that's where we are after episode 3. 3 companies on the board, none of them we would want to go anywhere near yet. And I'll see you guys in episode number 4, where we look at another company and add another company to the list. Cheers, guys.